Hello, Mike Molina here. First of all, I want to say sorry for my extended absence. That wasn't planned. I got really, really sick about 2.5 weeks ago, and I thought it would only be temporary. And then I lost my voice. And I couldn't even speak, and I still have a little bit left, but at least I can talk now. So I'm back with the minute. Sorry that it's been a minute, but anyway, I appreciate all the well wishes and everybody checking up on me. But I'm back in the saddle and looking forward to getting into it. So let's get into it with today's Mortgage Minute for Monday, September 26, 2022. You'll have to forgive the thumbnail, but you just got to have a sense of humor about these sort of things, because with rates going up so dramatically, borrowers not being able to qualify anymore, people losing interest in buying homes, it does kind of feel a little bit like everything's ending. So I just have to make a little joke to just try and get through the day about it. So first up, and this will be a little bit longer Mortgage Minute today to, number one, get caught up with everybody. And also, there's a lot to cover today. So first up is the economic calendar. All these arrows are important events. Tomorrow is a big day with Federal Chairman Powell is going to make some comments. The FHFA Home Price Index, the Case-Shiller Home Price Index, and new home sales. Then you can see on Wednesday, we have pending home sales. And then on Thursday, we have the GDP and initial and continuing jobless claims, with the most important event of this week being on Friday, the PCE, the Personal Consumption Index, or PCI, I should say. This is what the Federal Reserve actually uses it's their personal preference for measuring inflation. Depending on where that indicator goes will dictate both our short-term and possibly even long-term future in terms of the economy and interest rates. Now, this chart right here is why I need more than just 60 seconds today, because this chart may hold the answer to the question I get asked multiple times a day, which is, how long will this last? When will rates start to level off and turn around? So, as I have said many times, it's all about inflation. And as long as inflation is continued to be perceived as a threat, rates will continue to worsen. Now, this chart right here tracks inflation as the Core Consumer Price Index, which is not exactly what the Federal Reserve uses, but it's close enough for purposes of this conversation. So you can see here, this is historical. So this is starting back in June of 2021. And as you can see, these are inflation measurements, and it dips and then it goes up. October of last year, November, December last year, dipping, and then we see an acceleration. And if you recall, June this year was our highest point. And this is also where inflation hit its highest point. And then July was one of our better months for interest rates, and then things started to deteriorate again. And of course, we are where we are now. So when measuring year over year, if year over year inflation is perceived to be improving, okay, now right now, a year ago, September 2021, inflation was at 0.3, and the report just came out a couple of weeks ago to be at 0.6. So that's a dramatic increase. That is why the market is deteriorating so bad. But as you can see, next month, October of 2022, a year ago, inflation was at 0.6. So if we're at or below this level in October 2022, we may start seeing some relief. So here we have an opportunity to hopefully see inflation leveling off, if not improving. If it levels off and or improves, then we will see interest rates leveling off and or improving, okay? Then again, starting in April of next year, we can see a dramatic rise in inflation from this year. If next year, starting in April, we see an improvement in inflation, we will see a corresponding improvement in interest rates. So it's all going to depend on how inflation is being perceived. And that is taking a look at markets, well, there's just no nice way to say it. It's just basically a straight arrow shooting up, right? The treasury's going up, and so are interest rates. That's no secret. Taking a look at rates themselves, we can see that today we're at about 6.5 for a conventional 30-year fix. What I want you to take notice is that I've now added what the typical point cost is for these rates, because it's different. This is a unique circumstance. We don't usually have these kind of points being charged, but it is dramatic. You need to look at FHA. FHA is charging 1 to 1.5 points for these rates now, because the bond market for those loans is just not paying at all. VA loans, same thing, because that government money comes from basically the same source. Jumbo loans, better than conventional still, but it's still costing about a point. You can look at the historical, the last business day for Friday, as well as 30 and 90 days ago. That's it for today. Thanks for bearing with me. Tomorrow I get back on the standard 1-minute format. Please be sure to like and share. Thanks so much for watching, and have a wonderful day.